Sales Tax Survival Guide. Defensive strategies against sales tax audits, fines, and penalties. This video is to give you more understanding of what you are responsible for as to sales tax and be more prepared for a visit from the state or other agencies. We will cover 11 of the most important subjects you need to know, but each business is different and you should review all sales and purchases of merchandise and assets to be compliant. Number 1. Keeping broadening definitions of nexus from catching you unaware. Calculating, collecting, and remitting sales tax is not only good business, it is a legal obligation placed on merchants by the state in which they conduct business. Doing it properly is not only an obligation, it is the best defense against a hungry state auditors. Whether a company has sales tax obligations is the crux of the sales tax challenge. There are approximately 12,000 jurisdictions within the United States and 100,000 plus rules changing annually. That's a daunting set of variables few manual systems can handle. Nexus is a connection between companies and any given state that creates the obligation to collect and remit on behalf of the state. In addition to the significant physical presence such as warehouses or headquarters, Nexus can also mean a virtual connection. Large online retailers such as Amazon and Overstock are starting to collect sales tax, in some cases voluntarily, in states in which they haven't been before. Many retailers and other remote sellers are not currently required to collect sales tax in states where they have no physical presence. But states struggling to recover from economic recession see this uncollected taxes as a major source of potential revenue. Understanding the following changes in product taxable. Many states are addressing budget gaps by increasing the number of taxable products. Your business must determine which items are taxable and whether taxability varies from state to state. For example, many states don't collect sales tax on grocery items, but do tax processed foods that contain certain ingredients. Historically, most sales of tangible personal properties have been subject to sales tax. This has begun to shift to include intangibles such as professional services and installation services. Many states now routinely apply sales tax to services directly associated with goods. Knowing which service is taxable. Many states' services can provide tax-free for a number of reasons, including the status of purchaser and intended use of goods or services. Many states use true object tests to determine whether the product or the service is taxable. The true object test applies to physical items included in the price of services sold. If the main purpose of the transaction, the true object, is to receive services, then even if acquisition of tangible personal property results, the transaction is usually not taxable according to the true object test. However, if the true object of the transaction is the acquisition of tangible property, the entire transaction may be taxable. Number 4, finding the right sales tax rate to charge the customer. Don't make assumptions about geography. Many businesses make the mistake of searching for correct sales tax rate by zip code, which is similar to using the 1980 map to find a 2010 housing development. Unfortunately, taxing jurisdictions do not follow zip codes. Individual counties and municipalities can levy sales tax in addition to state sales tax, and sometimes tax rates can vary within the individual zip code. Geo-partial mapping, on the other hand, pinpoints each location against each relevant taxing jurisdiction. And the size of the company may make lumber sales taxed larger tax in California. Number 5. Tracking sales tax holidays. There were at least 17 states with sales tax holidays in 2014. And that will surely change in 2015. Sales tax holidays are specific days which sales tax is not charged on certain products and services. For example, back to school holidays in some states exempt clothing purchases from sales tax on specific days or below certain dollar amounts. Sales tax holidays give consumers an opportunity to purchase goods and services tax-free. By their very nature, these holidays can be a hoax and unpredictable, varying by type of goods or time of year or different periods of time, with absolutely no certainty from state to state. When handled manually, it is nearly impossible to track sales tax rules change with any consistency. Incorrect application of holiday breaks can lead to overcharging sales tax and ultimately additional cost in time and effort to correct the errors and refund the over collections to the customer. Number 6. Managing exempt certificates. Know which transactions are exempt from sales tax and how to manage certificates. Not all customers are required to pay sales tax. Depending on the rules in your tax jurisdiction, certain businesses and individuals may be exempt from sales tax. It is incumbent on the vendor, you, to collect and keep a file of valid exemption certificates for each business, organization, or individual with an exemption. It is also up to you to ensure that the exemption certificates are valid for each sales transaction. This requires your business to keep a copy of each exemption certificate and ensure they are renewed when they expire. A database or spreadsheet of exemption certificates should be easily accessible for easy accounting. The best solution is to tie directly into your financial system. Make it simple to verify exemption certificates are current, valid, and on file. When audited, businesses that manage large number of exempt certificates often find it difficult to link specific certificates with specific transactions. In other words, to provide the tax that was not due on a particular sale. Certificates also expire and may be invalid, potentially leaving the selling business liable for paying uncollected taxes. Number 7. Identifying registration and remitting processes for each state. Know where and how to remit sales tax. For each taxing jurisdiction, a business must meet filing deadlines and provide timely remittance using correct forms and formats. This step sounds simple, and it may be easy for many businesses, especially those with only one location. Such a business would be only responsible for collecting sales tax at the rate applied in the home city. Things grow more complicated when the business adds a location, and then another. With each new city or state, the number of rules you are required to follow grow exponentially. States are becoming increasingly aggressive in auditing businesses. Most states use a formula to determine which business will be audited, or examine the results of past audits to see which individuals have most compliance issues. Some businesses mistakenly believe that if they don't make major mistakes, they will not be audited. That is a dangerous assumption. Audits are often triggered by extreme factors, such as revenue shortfalls, changing tax rules, or even disgruntled employees. Number 8, understanding sourcing rules. Know whether the sales tax rules are based on shipments from or shipments to locations. Sourcing rules govern which state dictates the tax liability of a particular interstate sale. Those making within a single state follow the taxing rules for sellers located or shipped from addresses. This is called original sourcing. Conversely, sales between states, interstate, typically base taxability on the customer's location or shipped to address. This is referred to as destination sources. In distinguishing sources, nexus rules come into play. This can get very complex for businesses located in multi-states or operating as part of a supply chain, especially those using drop shippers located in other states. Understanding how and when to charge sales tax to customers and when to issue exemption certificates to distributors is complicated and creates an added risk for your business. Number 9, know your use tax responsibility. Don't assume your customers are the ones on the hook for use tax. All states that charge sales tax also charge use tax. Use tax are meant to minimize unfair competition between state sales made in or out of the state. But knowing when they are owed can be tricky. And because payments are often on self-reporting basis, most businesses and consumers overlook this obligation. So how does use tax work? If your business purchases goods from another company within the same state, sales tax is owed, which the seller collects and sends to the approximate tax authority. If your company buys goods outside your state or online, you may not pay sales tax, but you are required to pay the consumer use tax for the storage, use, or consumption of tangible property. Companies are responsible for self-assessing when and if use tax is accrued and to self-report on tax liability. Should any errors be made in computing use tax, they must be reported to the approximate jurisdiction on your balance sheet as an open liability. You must then remit the correct amount within your next tax return. The burden on you is to prove that the tax has been reported and paid. Number 10, expect the best, prepare for the worst. An auditor reviews a sample of 20 transactions in which no sales tax was collected. Exemption certificates for 4 of those transactions are not on file and not immediately available. The auditor will extrapolate from the sample and estimated that 20% of your company's non-sales tax transactions are invalid. Thus, the tax will be assessed as well as the penalty and interest. To survive an audit, the most crucial action a company can take is to collect sales tax properly over time. But while accurate collection is necessary, it is not sufficient. You must also ensure that you have properly documented every step of the way. Audits are much less painful when good documentation, such as transaction history, exemption certificates, and other detail, are at your fingertips. Accounting must track and apply sales tax laws changes across every jurisdiction where your company does business, as well as create and maintain detailed records of sales tax compliance activities. Sales must help the company determine whether new locations or accounts will bring with them additional sales tax compliance issues. I'm going to repeat that one. Sales must help the company determine whether new locations or accounts will bring them additional sales tax compliance issues. IT must make changes to accounting systems and e-commerce systems, in addition to allocating adequate electronic storage for compliance records. Number 11. Switching from an error-prone manual sales tax management process to an automatic streamlined one. Switching from automatic solutions are cost-efficient, and compliance can greatly diminish audit vulnerability. No system is absolutely foolproof, but with detailed processing in place, an auditor is more likely to give your company a clean bill of health. The streamlined sales tax states have partnered with private sector entities to become certified sales providers, or CSPS. The state also helps pay for the software for some retailers. Any business that uses streamlined certified software is immune from audit liability. Any business that uses streamlined certified software is immune from audit liability for the sales they process through that software. However, it is important to note that this immunity extends only to businesses registered with STT states that are using the certified provider. Okay, developing a sales tax strategy provides your company against audit fees and penalties. Make 2015 the year you manage sales tax, just not survive it.